If you've been investing in Alibaba recently, like myself, you're probably feeling some pain. The main reason being for every $100 you invested, say back in early 2021, is now worth close to around 50 cents on the dollar. Not a great result. And if you continue to buy the dip like me, then you've probably got your average down quite significantly, but still some way down on your initial investment. Now, the game of investing, of course, is a long-term one, and I, for one, don't like to pay too much attention to the near-term blips or volatile price movements. However, I think Alibaba has become one of the most unique situations in the market today and for some time, mainly because of its attachment to China and the potential risks that poses to investors, but also because of its undeniable business quality and low valuation, making it a very compelling play to some investors, and then on the other side, untouchable to others because of the China aspect. And for reference, Alibaba is now trading at what I deem to be a ridiculous multiple for a business that's growing in excess of even 15%, let alone the 25 to 30% that it's managed this year. Granted, that multiples are supposed to reflect the consensus for future growth of the business, but with 2022 to 2023 expectations of $163 billion in revenue and EBITDA of around $32 billion, implying 20% growth, Alibaba is now selling at a single-digit forward price to cash earnings and a PEG ratio on that basis of close to 0.5. Anyway, that's just some context on where we are with Alibaba, but in this recap/update video, I think we should look at what has contributed to where we are today and where does Alibaba potentially go from here. So in this real condensed timeline, you can see the beginning of Alibaba stock's downfall was the Ant Group IPO, a business Alibaba owned 33% of, still owns 33% of, being blocked by China's regulators, mainly because of new pending fintech regulations around consumer lending that Ant didn't currently comply with. But it was also sparked by Jack Ma's unkind words against the state-owned banks. This didn't just mean a potential reduced equity value in the Ant investment for Alibaba, which would have been a hit financially, but it also spooked investors because it highlighted Beijing's potential to intervene in business practices and the market economy. And this led to a sharp 20% drop in the stock price of Alibaba. And then following this news, Alibaba was hit with another blow as Beijing announced it was investigating the business practices of its largest internet companies to seek out and stop any anti-competitive business practices and potentially regulate the industry if that was what was required. And following from that investigation, Alibaba was handed a $2 billion fine for anti-competitive behaviour. The result of this and other news was a further 25% drop in the stock price. And although other bits and pieces have come out along the way, the latest drop, which we saw made the stock hit $110 per share, was primarily based on scares that BABA, the US-listed ADR, could be delisted from the New York Stock Exchange. And although no evidence has actually surfaced that supports this claim, fellow Chinese company Didi, who is listed in the US and was heavily criticised by the CCP for doing so, announced that it would be delisting its shares from the New York Stock Exchange and convert those shares to the Hong Kong Stock Exchange. Obviously, Didi is a separate business to Alibaba, and I will say a completely different situation just due to the scandal that was their IPO and what they did to actually go public. However, it did highlight to some the possibility that China stocks could be delisted in the future for whatever reason. And the stock sunk to its lowest point, like I said, to $110 per share, roughly where it traded just after its IPO in 2014. So that has obviously spooked a lot of people. And now the question is, why is that such a bad thing? Surely if Alibaba followed a similar fate to Didi, it would just trade over the counter like, say, Tencent and others do, or could be converted to Hong Kong shares, just like Didi is doing. And that's true. The likelihood is Alibaba, if it is delisted, and I'm not saying it is, I actually think it's very unlikely that it will ever delist, would trade over the counter and on the Hong Kong Stock Exchange, which, if your broker allows, would be accessible and okay to convert to, but with some fees incurred. I'd just suggest checking with your broker if you are concerned or want to know more. That's what I've done. That's what a lot of people that I know have done as well. So the real concern with most investors here, and it's I'd say a fair enough concern and does have some merit, is that If they are delisted, a lot of institutional funds and or say pension funds could be forced to sell Alibaba stock if the ADR shares are delisted, as some don't have the license to trade over the counter markets or trade in certain territories. This could in theory potentially spark a mass sell-off and large outward flows from Alibaba stock, driving the price down. So in the short term, yes, there could be blood on the streets if there is a delisting, but in the long run, if you're not concerned with stock price volatility and actually have the ability and plan to convert or hold your stock, that isn't a huge issue. So long as the business is still doing what it's doing and is producing sufficient cash flows for shareholders. And on our Discord, we've actually been having a lot of discussions about this and about what people are doing with converting shares, whether their broker actually offers this and if it's a sensible thing to do. And the consensus is some people have chosen to go down the route of converting ahead of time already. They've sold off of the US listed shares and gone with the Hong Kong shares. And some people are okay with just seeing what happens, like me, because in the event it does happen, I can convert my shares over. And so moving on from the most recent news, or FUD, you could call it, I think Alibaba's recent earnings may have played a part in the continued weakness of the stock as well. These earnings highlighted the fact that China's bounce back from COVID maybe is slowing down quicker than expected, and potentially the government intervention has had an impact on Alibaba's business. Not necessarily because of the Q2 results themselves, but mainly due to the weaker guidance for the remaining 2 quarters of their fiscal year, where they essentially are forecasting for 20% fiscal year 2021 growth. So full year 2021 growth will be at 20%, meaning the next 2 quarters would have to average around 15% year-over-year growth, quite a way down from Alibaba's current 30% year-over-year revenue growth. So they're hinting there that we're going to see some momentum slow down in the growth rate, which obviously is not a good thing and not something that investors wanted to see. And the other element is that Alibaba is potentially losing market share. I'm not saying it is losing market share. Of course, it's the largest player in the market by some way if we're thinking e-commerce, but some say and suggest that it's losing ecosystem control, losing some of its monopolistic powers, if you like, some of its competitive advantages, and therefore losing market share, and that trend will continue. And maybe that's why it's selling at a discount. But if we look at the data, and remember that's what's important here, Alibaba has fared pretty well against its smaller and more nimble competitors. Okay, PDD, for example, has grown its e-commerce sales quite rapidly versus the likes of JD and Alibaba, but JD's GMV growth over the past few years has not been much faster than Alibaba, and Alibaba still remains close to 2.5 times larger than JD in terms of GMV, and for its forward forecasting, JD isn't expected to grow much quicker in terms of its e-commerce sales than Alibaba. And also, if we look at the most recent quarter in segment, Alibaba's e-commerce revenue growth was actually quite substantially faster than JD's this quarter, averaging around 36% in USD versus 29% for JD, suggesting market share was at least retained. And now on the topic of losing market share, just to touch on this, is that not already priced in? That would be what I'd be asking myself. If that was one of my arguments that Alibaba's going to be losing market share, is that not already priced in? If we just glance at Alibaba's valuation versus its competitors, it suggests that the scenario is already fully priced in. And to a big extent, the likes of JD and PDD are selling at 3 to 5 times the price of Alibaba on a relative basis. The multiple you have to pay for their earnings or cash flows are 3 to 5 times more than with Alibaba. If we look at their non-Chinese competitors as well, it follows the same sort of pattern, 3 to 5 times more expensive. Now, we should also remember that Alibaba still has, in addition to its e-commerce business that's growing, the largest cloud business in China and in Asia, and has reached a revenue run rate today of 12 billion in annual revenue, with improving margins as well due to the economies of scale. So it's going to start contributing to the bottom line and profit. And it's the fastest growing part of Alibaba's business, and the cloud market in China is growing at above 50% on an annual basis, making it more attractive in terms of growth prospects than e-commerce and any of the divisions within PDD and JD, for an example. And so lastly in this update, I just want to review what the fundamentals look like for Alibaba now that it's selling at the low price of $125 per share. So on a market cap of $340 billion, in theory, with their cash and equivalents of $71 billion, plus the annual free cash flow of $25 billion, let's say, which is growing, they could buy back, at the moment, 29% of the shares outstanding over the next 12 months if prices stay where they are. Obviously, this won't happen. They won't be spending all of their money on buybacks, but it demonstrates the fundamental value that exists and how cheap this price has really got relative to the earnings that it throws off. Also, the current price implies a single-digit multiple of their e-commerce net profit. The e-commerce net profit is excluding the loss-making businesses, so all of the other areas of the business, that's including cloud as well, that drag the group profit number down and the margin down of the group. So this implies that you're getting a 10% earnings yield or above a 10% earnings yield just from the e-commerce business of Alibaba, which is growing, like we've said, growing at a double-digit clip. So to me, that also implies that you're getting the largest cloud business in China and the fourth biggest in the world that's growing rapidly for free. And also, you're getting 33% of the largest fintech business in Ant Financial for free as well. So that seemed like a lot of value packaged in to a very low price. And there's a lot more that I could go into with this update, but I think I'll leave it at that, and that I still see Alibaba as undervalued, even more undervalued than when I've last done an update, but with obviously some turbulence ahead. I don't think it's going to be smooth sailing. I'm not saying that. I can fully understand why some people don't want to get involved and may look elsewhere for value, but for me, it's an opportunity that I'm not willing to miss. So with my remodeling and some adjustments in the forecast, I still see Alibaba's fair value as being anywhere north of $200 per share at the moment, probably north of $220 per share if I'm being honest, but it depends on how you see the next few years playing out in terms of growth. And of course, these are my estimates and not to be taken as financial advice. Everything is based on my own assumptions and my own analysis of the information currently available, so just keep that in mind. So that's going to be it for this update. As always, I will leave a link to the Patreon in the description below where you can download my Alibaba valuations, take a look at that yourself, maybe plug in your own assumptions and use it as a template, and also other valuations that I've done on various other businesses. And also you'll get access to exclusive analysis as well. You'll also get access to the Discord where we discuss all things investing, and you'll get plenty of other benefits too. But apart from that, please hit the like button if you enjoyed the video and subscribe to the channel if you are new. I will see you all in the next one. Good luck with your investments.